Hello friends, welcome to FI Talk. A major initial public offering, IPO, recently took place on Wall Street, boosting optimism among bankers that the market for newly listed company shares is showing signs of improvement. The solar technology company, Nextracker, raised more funds than expected by selling shares, amounting to $638 million. The sale involved the release of 15% more shares than initially planned. The successful listing, which began trading Thursday, suggests that the stock market's recovery this year has renewed interest from mutual fund and hedge fund managers in new companies, as noted by Michael Wise, Vice Chairman of Equity Capital Markets at J.P. Morgan Chase. During midday trading, Nextracker shares rose by 25%. For the past year, the IPO window, which enables companies to access investors for new stock, had been mostly closed. This led to a significant decrease in the proceeds from public listings, reaching a low not seen since 1990. The Federal Reserve's interest rate hike was a key factor that caused the disruption, leading to widespread industry layoffs, and forcing private companies to reduce their workforce in an effort to preserve their finances. Private companies extend their runway by cutting expenses, such as employees, in order to preserve their finances and avoid seeking capital or going public until the market conditions improve. Wise commented that the window seems to have opened slightly, with the strong market performance this year rekindling interest among investors and issuers, and many companies are now undergoing pre-IPO processes. Following the Nextracker listing, other renewable energy firms, such as Tel Aviv-based Enlight, are reportedly planning to list in the U.S. J.P. Morgan, based in New York, is serving as the lead advisor for both of these deals. It has been observed by Andrew Wetenhall, the co-head of equity capital markets in the Americas at Morgan Stanley, that there is a greater degree of involvement from investors in bringing IPOs to market compared to the majority of last year. Dealogic data reveals that Morgan Stanley, Goldman Sachs, and J.P. Morgan are amongst the top advisors globally for public listings. However, not all companies can take advantage of the market revival. Investors have lost interest in firms that are unprofitable, and many tech listings from 2020 and 2021 are still facing losses. Currently, sectors such as green energy, which is partially attributed to the Inflation Reduction Act, biotech companies with promising drug trials, retail brands that have weathered the current circumstances well, and certain segments of the financial sector like insurance, are in favor among investors, according to bankers. It is emphasized that for a company to go public and be successful, it must be profitable and belong to a sector that is performing well or is at least not greatly affected by rising interest rates. Wetenhall states that while the market is opening, it is not fully open, and only companies that meet the current investor sentiment and expectations should pursue going public at this time. Thank you for today. Make sure like the video and subscribe the YouTube channel.